Inflation robs every American, every one of you.
This is not the first time in the history that inflation is that high.
To stop the rise in the cost of living.
Shortage of supply, increase of money in people's hand, that sounds very similar to today's situation.
I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators.
To understand future, we need to look back into the past. This is not the first time in the history that inflation is that high. The last time was in the 1970s to 1980s. So let's take a look at the facts from that period to help us better predict the future. It all started in 1965 when US joined the Vietnam War. At that time, the government rapidly expanded various social programs, including Medicaid, Medicare, food stamp, etc. These various programs put more money into people's hand. At the same time, the war is consuming all the resources and the supplies and created a shortage of supply. Shortage of supply, increase the money in people's hand, that sounds very similar to today's situation. In today's world, we got war that's happening in Ukraine, the China lockdown that is shortening the supply, and we got federal government stimulating economy by issuing a whole bunch of checks to people, put money in consumers' hand during the COVID period. So this is very similar to what happened before. So in 1965 leading up to 1971, where the inflation has reached to about 5%. So in August 15th, 1971, President Nixon had took a drastic measure to combat this. He made several announcements through televised broadcast. First announcement he has made is to freeze all prices and wages.
I am today ordering a freeze on all prices and wages throughout the United States for a period of 90 days. In addition, I call upon corporations to extend the wage price freeze to all dividends.
Everybody focused on the wages and prices because that is a much more drastic measure. But here, the next thing that is really important he announced is that United States will no longer convert dollars to gold at a fixed rate.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
This leads to today's government's ability to print a limited amount of money. It seems logical, right? When you have inflation, you just need to freeze all the wages and prices. So did it really work? Well, not really in the long term. So we're seeing when he put that policy in the 1971, we see the inflation did come down a little bit. It went from over 5% in 1970 to 3% in 1972. That's when he has started the second phase of the pricing and wage fixing. The second part of the policy allows selected business with government approval to increase the wages. Anytime you have the government controlling what your business income would be, things gets really wonky. As soon as that partial wage increases were put in place, inflation has came back with vengeance. This is logical because if you're holding off the tides, the water is increasing on its levels, and when you let the floodgate open, everything just kind of rushing in. So as such, the price freeze curbed a little bit, but then really jump-started the inflation in 1974. We see inflation actually has hit 11%. So price fixing and wage fixings is not really the solution, but could the government try? Yes, certainly. In fact, some form of this has already been implemented. For example, during the COVID, the CDC has put an eviction moratorium. When you have a tenant that lives in your housing without having to pay your rent, then you effectively has a price fixing issue. But that type of fixing price and wages never worked. So as a result, we see a 21% average rent growth across the nation. It's simply catching up to the inflation. If you like our content, please like this video and subscribe to our channel. If you're an investor that holds a cash flow business with the price and wage fixing, you're not going to have increased income, but you also have fixed expenses. So you're probably likely going to be okay. If you have a cash flow business today, you may want to accelerate the speed of catching up to market rents, because once the price fix is put in, that announcement is going to happen overnight and you don't want to be left behind. The other side effect of such pricing freezing is creating a really weird economy. For example, back in the 1970s, an X-ray technician who went through years of school made $187 a week, while the porter working for the city made $203 per week. That just doesn't make a lot of sense. And the things that appear to be largely unfair will lead to social unrests. So the price freezing didn't really work. And this continued on until 1981, where the inflation really hit an all-time high at over 13%, higher than today on the books. Some unofficial report may be reporting to even higher inflations. So what stopped the inflation? In 1979, Paul Volcker became the chairman of the Fed and made it his mission to fight inflation. So he did two things. Because he did two things together, we don't really know which one is more effective. First, he increased the federal interest rate as high as 19% in 1981. Second, he rapidly increased also the interest rate the large bank is borrowing from the Federal Reserve. This curbed borrowing. Essentially, if the interest rate is so high, the banks are not making money. And if you target large banks, then the large bank all of a sudden are not doing volume. So when nobody is borrowing, no money is created, and therefore it kills the money supply. So excessive money supply leads to inflation. By killing money supply, you're effectively going to combat inflation. So finally, inflation has come down to 3%, then later 2% in 1983. On June 15th, there's another FOMC meeting. And in July, there's another one. And they have indicated an interest rate hike of 50 basis points for each of these meetings. By hiking the rate so high, it makes no economic sense for lenders to lend anymore. And we have seen some of that effect taking in place in the market. And that's going to continue going for a little bit extended period of time, we believe. Stock market now is actually having bigger GDP shares than back in the 1980s. Hiking interest rate can be very sensitive to stock market. By crashing the stock market, it creates a political environment when the rate hike has to stop. So potentially the rate hike wouldn't be as drastic as we see before. In our previous video, we talked about our prediction that by hiking interest rate more than 2%, we believe the yield curve would be in inversion form. When the yield curve inverted, it potentially is a lead indication to a depression ready to happen. The other methods to control this by shrinking the Fed balance sheet, because they can potentially eliminate a lot of dollar in the system, and that's another way to fight the inflation. As real estate investors, how high would the interest rate go? We don't really know, but again, do we really want to find out when it's too late? No. So if you're evaluating deal and investing in real estate right now, or investing in business right now, getting a loan, getting a fixed rate debt and building up your cash reserve are highly recommended.